here we are at our very first rental property.
Welcome in, everyone, to the Investing in Real Estate show. I'm your host, Clayton Morris. So great to have you here. I'm a longtime real estate investor, quit my 9-to-5 a number of years ago, and this show is devoted to helping you build financial intelligence so you can build financial independence and financial freedom. And sometimes we do some high-level ninja trick episodes that deep dive some really important strategies that the wealthy people understand. Capital gains being one of those sticking points, right? That's why we heard last week or a couple of weeks ago, President Trump considering a capital gains tax cut because that could have a broad impact on the economy. So capital gains, how can we exceed some of the limitations and some of the tax deferral limitations that exist right now with the capital gains tax laws? We've got an expert on the show today. It's Brett Swarts. He's the CEO of Capital Gains Tax Solutions, and he's done you just recently did $85 million in commercial real estate transactions. So he knows a thing or two about this entire process, and he's going to help us deep dive some of these interesting points about capital gains and other parts. Brett, welcome to the show.
Hey, Clayton, thanks for having me.
Absolutely. Well, good to have you here. So give us a little background. How did you get into this? This is not something that you just pick up randomly. You've certainly got your 10,000 hours of knowledge on this. So take us back a little bit. Introduce yourself and how did you get started doing all this?
Yeah, thanks. Yeah, Brett Swarts. I'm here in Sacramento, California. I grew up mainly in the Bay Area and then in Sacramento. I started with the sticks and bricks of real estate with my father, building homes in I call it the MC Hammer days in the 80s in the hills of Mission San Jose. And kind of learned the entrepreneurial and real estate game from my father, but then went on to college and took an internship at a place called Marcus and Millichap, and exactly where I started my career. So I started studying investment real estate and studying how to help people buy and sell mainly apartment buildings. And I still help people sell apartment buildings. But along that journey, I like to say, the fire of this 2008 to 2010 really, crash there. You start to learn and get creative of ways to find deals. I mean, the marketplace kind of fell apart for commercial real estate in the sense of transactions and people making sense of deals and, financing. You guys know that story. But along that journey, my manager at the time introduced a gentleman who came and spoke to our office and spoke about this strategy called a Deferred Sales Trust, an alternative to a 1031 exchange, a backup plan for a failed 1031 exchange. And so I started to study the structure. I like to say I'm more the tortoise than the hare. I poke the structure and just try to understand it and slowly sent referrals to clients to this structure and strategy as I saw fit. And fast forward, it's now back to kind of the 06, 07 values or even greater now. And a lot of these baby boomers are looking for an alternative. So I would say I learned through just osmosis and being curious about ways to add value beyond what everyone else was talking about, which generally speaking in the commercial real estate world is just the 1031 exchange.
So for our audience, we've definitely done deep dive episodes on the 1031 exchange, which is a very powerful wealth building tool. But to my audience that may be listening for the first time and has no idea what we're talking about, dumb it down for us. I mean, talk to me like I'm a fifth grader right now. Explain to me what a 1031 exchange is, and then how what you've discovered builds upon that.
Yeah, so a 1031 exchange is just trading like-kind real estate into another piece of real estate within a period of 180 days in order to maintain tax deferral. So it's a code in the IRS called IRC 1031, which allows you to, as long as you play by those rules, you're going to defer your capital gains tax and depreciation recapture. And so, sell a 4-unit complex and buy an 8-unit complex. As long as it's equal or greater value, so there's some rules you follow, within 180 days, you're going to maintain not paying that capital gains tax and building wealth off of what the government would have taken anyways.
Right. So it's a powerful wealth building tool because then you're not having to pay that capital gains, as you just said, but you're able to, maybe you had that really ridiculously expensive A-class property in Phoenix, Arizona, that's now worth $1 million, but it's one property and, you have one tenant. Well, what if you took that $1 million property and you were able to convert that and buy 50 properties, right, in different parts of the country that are all, so that's how that works, right? And then all along that way, not paying taxes because you're deferring it, you're deferring it, you're deferring it.
Correct. It's kind of like an interest-free government, a loan from the government. They say basically, Clayton, we're going to give you or allow you to continue to defer that million in tax you owe us or whatever you owe us, as long as you invest it into a property, which in turn is going to be some benefit to the community, right? It's going to help maybe revitalize an area. It's going to help maybe you're going to add some value to that property. You're going to provide public housing, not public housing, but private housing. So these are all ways to actually spur economic growth. They're the reason they have these legal loopholes in place so that honestly, the greater good is a better place to live in.
Right. We always talk about partnering with the government. The government wants you to partner with them. The tax code is written for you to be partnering with them in this way. Okay, so that's the 1031 exchange. Thank you for that. Now let's take it to the next level. Let's talk about the Deferred Sales Trust and how this builds on that or exceeds that.
Yeah, so the big thing that baby boomers are facing right now, and this is kind of the big demographics, Clayton, it's the largest wealth transfer in the history of the world. In fact, according to the American Bankers Association, it's about 17 to 20 trillion will pass from one generation to the next in the next 20 years. And there's about 77 million baby boomers in the US alone. And every single day, about 10,000 of them turn 65 years old. And so they've made their wealth for 20, 30, 40, 50 years. In what? In business, in commercial real estate, and with their primary home. In fact, those three categories represent 50% of total net worth for the US, right? Commercial real estate, private equity, which is like business, and a primary home. So all three of those things in all of this large transfer, these baby boomers, they actually feel trapped. What do they feel trapped for? Because they don't want to necessarily do another 1031 exchange. They don't want new toilets, new trash, new liability. They're also trapped because 30 to 50% is going to be wiped out by capital gains tax and depreciation recapture, depending on what state they live in. And so, but they want to be done. They want to transfer it to the next generation. They want to enjoy their wealth. So the other part of this perfect storm that's sort of happening, that's what we like to call it, is the fact that you have real estate that's appreciated a great deal. And we're basically 10, 11 years since the big crash in '08. And they don't want to go through that again, right? They want alternatives, and they want to be done. And they want to be diversified. They want to be liquid. They want to be able to invest in commercial real estate at any time, not be forced to have to overpay for a property. Also, interest rates are hovering near 40-year lows, which in some ways is sort of propping up values as well. And so we call this the perfect storm facing the baby boomers. So how do you solve that? Well, enter the Deferred Sales Trust. You can now sell a highly appreciated real estate. And by when I say now, I mean you could always have done this. In fact, this tax law goes back to the 1920s. It's just an installment sale, which is what a Deferred Sales Trust is. We just call it a specialized installment sale, where we're using the tax laws, and we've been tested and tried over a 23-year track record, thousands of closes, 14 no-change IRS audits. The largest deal was for over $100 million, but we've done veterinarians, we've done dentists, we've done apartment complexes, self-storage. And essentially, instead of doing a 1031 exchange, you can put it all into this Deferred Sales Trust at closing, of which all your debt is paid off of the asset. So now you're debt-free, and now you're liquid. And by liquid, what do we mean? Well, you could put it with your own financial advisor or use one of our strategic partners and put it in stocks, bonds, mutual funds of your choosing. Now, I'm not a big stock bonds guy. I'm more of a commercial real estate guy. That's what I love. And this is the best part. Up to 80% of those funds can be directed to a syndication of your own or someone you know. So let's just say there's $1 million in the trust tomorrow. You just sold your business and it's all tax deferred. You would have had $600,000, but now you have $1 million. 80% of that, $800,000, the very next day can be sent to an LLC, of which you can purchase into a partnership or buy your own real estate, all tax deferred. So it becomes what we call optimal timing, which is the best thing. What you would have done in '08, of course, before the crash, had you known about this, we call this the Monday morning quarterback. You would have sold in '07. You would have paid off all your debt. You would have sat in this Deferred Sales Trust and very liquid, diversified, safe investments, because there's a lot of safe stuff you can put it into, and waited for the market to shift. And then bought properties at 60 cents on the dollar. In fact, that's what one of our clients did in Minnesota. He sold a large building, and in '06, he waited 5 years. That same building was foreclosed on, And through his trust, he purchased it tax deferred at 60 cents on the dollar, which, oh, by the way, it provides a brand new depreciation schedule, which is also something that the 1031 does not do. The 1031 only, you travel with the depreciation schedule. And this is an important point because the number one reason, at least in my book, to own investment real estate is the ability to offset the income that comes in by the depreciation and not paying as much tax, but still having that income. And so in a 1031 exchange, unfortunately, it's traveling that schedule. So eventually you run out. Whereas with the deferred sales trust, it gives you a brand new depreciation schedule because we're not buying it through a 1031 exchange. So I'll pause there because there's probably a few questions or thoughts you have.
Yeah, I'm just letting all of this sink in because this is incredibly powerful and it's new to me. I mean, we've done whole episodes on trusts. We have a trust, the way that we've structured things, but does this work for the average person? Do they have to, is there a certain monetary limit? So if someone has, let's say, 5 single family homes, they're each worth for round numbers, they're each worth $100,000. They bought them for $50,000 20 years ago. They're going to sell them. How would this work? Give me, using that example, can you walk me through it with your trust?
Yeah, so there's 5 homes, each are worth $100,000, okay? And then they bought them for 50, 5 years ago. So they each have a $50,000 gain. And depending on what state they're in and depending on how much depreciation recapture, let's just use 40%. So we'll do some quick math here. So you've got $100,000 times 5, so that's $500,000. And let's say that it was $250 was their gain. So at $250,000 gain, let's use 40%. You're looking at about $100,000 in liability. So what we always do, Clayton, is we say, well, what are you selling for? And the answer is $500,000. What is your actual liability? What's the check you're going to write? Not just your gain, your actual liability, right? State, federal, Obamacare, depreciation, recapture. And let's just say that happened to be 40%. In this scenario, it's $100,000 in liability. So we can say, Clayton, do you want $500,000 in your trust minus some fees? There's some fees, or $400,000. So that particular scenario is right on the edge for the ROI that we found. We found for every $500,000 of gain or proceeds, there needs to be about $100,000 in liability that we're offsetting in order to make sense of the fees. And this is the rule of 72. If we can earn 7%, Clayton, on that extra $100,000 over a 10-year period of time and let it compound, it's going to double, right? And then at that point, you can pay your tax. So that's the rule. Most of our deals, the average size is about 2.6 million, and we're deferring somewhere around $400,000 to $500,000 in liability. So it does work, right? But also to that point, that individual who has 5 single-family homes, he likely doesn't have them all in the same exact location, right? Let's say he has 10 or 15, and they're all spread apart. His typical option would be to put them all together and to sell them to an investor, which generally speaking, they're going to pay about 20% less than a primary homeowner would. Okay, so what we like to say is don't do that. Still sell them to the primary homeowner to get that 20% value, but slowly do that into the deferred sales trust. In other words, you don't have to sell it all in one deal and do a 1031 out of it, right? Just simply combine them into the trust one at a time as you see fit, as you find the buyer, as you negotiate each deal. So now hopefully you've had a 20%, maybe you're not selling for 100, maybe you're selling for 120 now. And now once they're all in the trust, again, 80% of that now can go purchase more real estate.
Wow. Okay. So you mentioned that the slow pace of which you can do that. Can you go into that a little bit more? Because with a 1031 exchange, you have that time limit and then you're under the gun, right? You've got to find the other new properties that you're going to be buying, like in kind, upgrading, so to speak. Talk about the time limit again with this trust, maybe dive a little deeper.
So the intent is optimal timing. So we have a saying around here that goes, we want you to buy at optimal timing. What is optimal timing? Well, it's when it makes sense for you. It's when you find a deal. Right? It's maybe when the market shifts. It's maybe when your lifestyle changes. Right now I have 5 young kids and my strategy is more to be passive with other operators who are focused on that while I focus on my business and my family. Right? So my optimal time is different from someone else's optimal time. Maybe that person who owns 25 homes and he's built a portfolio up for 30 years, maybe his optimal time is to retire or buy when the market makes sense. He went through the 08 crisis. So he could slowly, because there's no time limit with the deferred sales trust. We are a separate tax code. We are IRC 453 versus the 1031 exchange. IRC 1031, right, which has the 45 days to identify and 180 days to close. And generally, you have to replace equal or greater value, which means you have to replace the debt. Also, the entity must move. So you have all these rules to follow for the 1031 exchange, right? Whereas the IRC 453 is very flexible. It's an installment sale that doesn't have those rules. So you could just slowly sell multiple properties as you see fit when you find the buyer and pay off the debt, move them into the trust. So you're getting your powder dry, you're getting your cash on the sidelines, you're getting diversified, right? And that's the other part. Diversification is not just into other asset classes, but perhaps it's with other operators in different geographical locations across the US. Generally, the 1031 exchange, your people are picking the 3-property rule, which means you basically have 3 properties to choose. And generally, they're also staying in the same product type they've always been in. And generally, it's the same geographical location. So they're not as diversified as they could be if they said, okay, Clayton, I have $1 million in my trust now. It looks like you have a nice deal in Florida. We'll put $100,000 there. It looks like you have a nice deal in New York. We'll put $100,000 there. And it could be different product types. Maybe you have someone you know who does mobile home parks or multifamily or senior housing. And then you have the single family one. So you can diversify outside of your commercial real estate holdings whenever you want, all tax deferred without any debt in necessarily your name, unless you're buying that deal as yourself and putting the debt in your name, which is different. But it's very, very flexible, I guess, is the answer here.
I was just about to say, it sounds incredibly flexible, way more flexible than the 1031 exchange does. Who is this not for? I mean, it sounds like, given that sort of monetary threshold, this might not be for the person that has 3 single-family homes. It would probably be for higher net worth individuals who are pushing up higher into that price range, right?
Right. So we talked about the values, right? Where are the values and the liability? And that's just a return on investment, ROI analysis you run quickly on. So if the liability is too small, let's say you're selling a deal for $500,000 in proceeds and there's only $25,000 in tax, Clayton, or you say, just pay the tax because our fees are going to eat up that $25,000 in savings, right? Or if the ratios are out of whack, you're selling a $10 million deal and there's only $100,000 in savings, still just pay the tax, Clayton. That's too small. Just take the 9.9 and just wait for a deal you find, right? You don't need us. So it's not for the small deal. That is true if the liability is too big. The second one it's not for would be for someone who actually can find a forced appreciation value add 1031 deal. So if you're a professional investor and you can find that deal, hey, we want to cheer you on. I'd still do 1031s. I love a 1031, right? I just did an $8 million value add retail deal in Vacaville, and I did another $4 million deal in Sacramento for a value add retail office. Doing apartment buildings right now. So I still do 1031s, but here's the key. Why don't you have a backup plan just in case it fails? And that's where we come in. We can give you that backup plan or that security in case the seller won't deal, the bank won't lend. Everyone should have a backup plan. We don't charge anything for the backup plan. We just have it as a placeholder ready to go. And by the way, it doesn't take one of your 3 positions because it's not a property. So it doesn't affect you at all. There's no negative for having the backup plan, only upside in case it fails. And we get calls like that. We've saved multiple failed 1031 exchanges in the past few months. Okay. So it happens,
Wow.
Outside of the buyer's control. So it should be for every single real estate investor, either as a backup plan or as an alternative. Maybe they want to do half and half. You can do a partial 1031 and a partial deferred sales trust. Maybe you sell a $2 million deal, Clayton, and you find the perfect $1.2 million deal. And you have an extra $800,000, and we call that boot. Well, we can take that $800 and put it into the trust. Okay, so you did half and half. So, but it's definitely for the business owner. The guy who's selling a $5 million dental practice or a $3 million veterinarian or whatever, trucking company. They really have no 1031 option. They don't have anything. They just sometimes do an installment sale of their own, which has its downsides. But we want to say, no, don't do that. Get diversified, get liquid, get into a passive income stream, commercial real estate, or by the way, another business venture. It also works for people who are in, we call it Silicon Valley, who are getting bought out by the big tech companies. They can fund their own next business venture with 80% of the funds instead of having to get funding from a venture capitalist or maybe have the golden handcuffs from the Facebooks or the Apples to say, we're going to give you all this stock, but you're basically going to be with us for this amount of years. They can say, no, I want to go create another business. Keep all that stock, put it all into this deferred sales trust. I'm tax deferred myself, and I'm going to use that funding to go fund my next venture. So the onion can be peeled back quite a bit. We just want to start with, what are your goals? What are you trying to do? It's your money. How do you want to receive it? Some people don't want the income. Some people say, look, I'm making too much income right now. I'm doing a deal right now out of Florida for a dental practice, and they're still in their 40s, and it's a big, big sale. And they're like, we actually don't want the income. So the trust itself can let the income compound, and they don't have to receive that income and pay taxes on their personal tax return. And it's just going to compound kind of like a retirement account. And at a certain point, when they stop working, they can start drawing that income and then paying taxes in that given area. Oh, by the way, they may move to somewhere like Nevada. They already live in Florida, so it's pretty friendly for taxes. But say someone was in New York, they can move to another state, establish residency, and then start receiving income. So there's so many advantages to this deferred sales trust that we just want to educate you, your trusted advisors, and get their blessing before moving forward. So that's what we're about.
Well, what I love to do, and thank you so much, Brett, for giving us that 101 high level overview of this. It wasn't even high level. It was high level, and you also went very deep, which is awesome. What I would want to do is have you back on, maybe in a few months, we'll have you back on the show. And anyone who's watching the video version of this or wants to send in a question to us via email, we can go a little deeper. So that's what we've done in past with some of these deeper subjects. So anyone that has deeper questions, we can have you come back on, and we can go even deeper on some of the more specifics on this. So I really, really appreciate that. In the meantime, Brett, how can people connect with you at Capital Gains Tax Solutions if they want more details about how this all works?
You can search YouTube. You can search, of course, the website, just capitalgainstaxsolutions.com. And also LinkedIn are the best ways. We also have a free webinar that they can access, which is great. So you can literally see this and pause it and replay it, how it works, why it's legal, our track record, and see the arrows move here on everything and the advantages versus the 1031. By the way, this is not to be confused with the Delaware Statutory Trust. Sometimes people, because it's both DSTs, they get confused. So just go there and get educated and get empowered with the strategy. Our goal is just to empower you and your advisors, your trusted. We have thousands of professionals, CPAs, tax attorneys, commercial real estate brokers, and just get equipped with it. So go there, get equipped with the strategy, and then use it to see how you see fit. And we'll be your guide when you're ready.
Awesome. Well, thank you. My guest has been Brett Swarts. He's the CEO of Capital Gains Tax Solutions. We'll have links to all of this in the show notes page in the description below. Thanks so much, Brett. Thanks. Really appreciate you joining us today.
Thanks, Clayton. My pleasure.
And thanks to all of you for downloading and subscribing. And thank you for all of your kind 5-star reviews in the iTunes store. If you're listening on Overcast, which is one of my favorite apps to listen to podcasts, by the way, hit the recommended button and share it, or you could leave a 5-star review. We always try to read those on Monday's episodes. So thank you so much. Now go out there, take action, become a real estate investor. As you heard from Brett, there are so many ways to peel back this onion to build wealth. We'll see you next time.